Agam Gupta, Managing Director, FI Trading at StanChart Bank, now joins in on the show. Agam, what would be your assessment of the kind of policy actions that have evolved over the last few months and what that would mean for the RBI in its upcoming policy? Because there are quite a few options at the table.
Yeah, so I guess we have to look at what the new governor is doing. He has clearly indicated that he is okay to raise the repo rate to fight inflation, and he's also indicated that he wants to unwind the emergency measures which were announced on July 15th and subsequently as soon as possible, as soon as the currency stabilizes. So I think in the policy he will probably take steps towards both. What we're expecting is that they'll probably raise the repo rate by 25 basis points and cut the marginal standing facility rate by 25 basis points in this policy.
10-year bond yields continue to remain sticky above the 8.5 mark, and even the call rates have remained more or less in 8.8 to say 9.10 to 11 kind of a corridor. What are exactly the bond market and the currency markets pricing in as far as RBI policy is concerned?
Well, the call rates will monitor the marginal standing facility rate as long as there's a liquidity deficit and there's a cap on the repo rate. So that's quite clear. That's where the RBI intends it to be right now. If they intend it to be lower, then it will come off, and we expect that process to be underway in the coming weeks and months. As far as bond yields go, I think we are basically caught in a range right now because the market is expecting the rates to be hiked on the repo rate. Some people are expecting it to be done once, some people are expecting to be two hikes. So if you're looking like at a repo rate of 8% in the coming weeks or coming months, and the bond yield, the 10-year bond yield at 8.5% is pretty justifiable because you do expect some steepness between the overnight rate and the 10-year rate. So expect it to continue to trade in a range of something like 840 to 875 on the 10-year.
Agam, just a quick, to get right back to the RBI policy, if we look at the trajectory since May 2013, there were so many external headwinds in terms of the QE policy, the kind of depreciation that we saw for the rupee, the QE tapering, but the external imbalances have somewhat improved now. What do you think in light of this will now be the tone of the Reserve Bank in its focus on growth and inflation?
You're right, the external imbalances have improved a lot. I think especially the biggest improvement is on the current account deficit side. Till some time ago, we were even a $70 billion current account deficit for this financial year was looking difficult. But now it definitely looks like we could probably get something better than $70 billion also, closer to $60 billion. So that's one big improvement. That should help stabilization of the currency. And I think that has helped in the stabilization of the currency, apart from the RBI schemes, of course, which have helped change sentiment in the last month. The RBI policy basically is focusing on inflation right now, and which is clearly evident from the fact that the governor hiked the repo rate in the first policy meet. Obviously, growth concerns are there. They have made statements to the effect that a low growth is also disinflationary. Having said that, I think they're still uncomfortable with the high headline inflation. So we expect the repo rate to be hiked to fight the high headline inflation. But the RBI will definitely keep in mind that growth is also low. So, it won't be hiked a lot, but it could be hiked by 25 to 50 basis points in the coming policies.
Right. Agam, what explains the weakness in the rupee in the light of the dollar index, which continues to trade below 80 and is weak, and at the same time the inflows into the equities remain quite strong?
Yeah, so rupee, I won't call the rupee weak, but yeah, it's basically not appreciated as much as some people would have liked it to, or some people would have thought. I think the move from 60 to 68 has kind of that overhang of sentiment is still there to some extent in the market. So what we are seeing is that every time the dollar rupee dips towards 61, we are seeing a bit of importer buying, and that's what's keeping it from going below 61. What you're saying is right. We have seen reasonable amount of equity inflows. We've also seen And we also know the fact that the RBI has taken a lot of the oil demand out of the market for the last couple of months. So, I mean, the other source of demand in the market seems to be some small buying by the RBI, because their reserves have been going up more than, I mean, it would add up to, if you kind of add up the oil window and the swap window impact. The reserves should have dipped a bit, but the reserves have gone up slightly. So we think that maybe the RBI has also been buying and accumulating a bit on the FX reserve side. That's keeping the rupee in a range of 61 to 62.5.
Okay, Agam, we'll leave it at that. Thanks very much for joining in and giving us your assessment of all of that's happening in the macroeconomic space.